Hello everybody, welcome back to the channel. So today we are starting part 2 of chapter 3, that is double entry bookkeeping. We already covered chapter 1 and chapter 2, which is theory based, and you can check the videos in the description box. Let's start. So we are starting with the accounting records because we already covered source documents in our previous lecture from in the part 1 of this chapter. So let's start. When the relevant document data source has been received by the financial accountant, he or she then needs to make a record of it in an appropriate place in the accounting system. However, transactions cannot simply be entered in the financial statements for the shareholders. There is a complex accounting process that has to take place before the results for the year can be summarized, right? Many controls have to be performed to prevent and detect fraud and error before the final results can be prepared. Now let's understand this. So for example, this is an accountant, right? Whenever he or she will receive source document, okay, I'm writing it in short form. Source document, right? Like the bill, there are so many kinds of source documents, right? As you can see, there are so many, like purchase order, sales order, dispatch note, invoices, statements, credit note, debit note. So there are remittance receipts. So there are many different types of source documents that an accountant can receive. So the next step he will take is to record that transaction into the journal, right? And then we'll make ledgers, right? Ledgers. And then finally, trial balance, by which he will be assured that all the transactions he entered into the ledger are correct, right? Debit is equals to credit. Now, after all this process of recording, right, this is the process of identifying. This is the process of identifying, right? And then recording and classifying. The next step he will take to record that transaction into the financial statement for the shareholders. And who are the shareholders? The lenders, the owners. The lenders are the person who lend money to us as a loan, right? And they will check if the position of that business is good, then he will or they will give us loan. And owners are the shareholders, customers, public is also comes in the category of shareholders. Even the employees are the shareholders. So it is a long process to understand the shareholders. I think this topic is in the chapter 2 or chapter 1. You can check that. Now let's understand this. The accounting system is also used to monitor the effectiveness of the business and to help conclude relevant transactions. Yes, accounting system can be monitored, can be used as a monitor to owners and all that shareholders can easily check that all transactions are in their right places, right, are recorded in their right places. For example, many goods or services are sold on credit, giving the customer a number of days, months to settle their debts. Credit control requires information from the accounting system with regard to who has settled their debts, and for that reason who needs to be chased for the payment, right? Credit control is something that that allows customers to have days or months period to settle their debts. And if any of the customer that doesn't has settled their debts, so they are chased for the payments. They will be asked for from that business, from that owner, from that company to chase the payments, previous payments, right? Now let's understand the flow of information from the initial transaction to the financial statements. As I told you before, the evidence that allows you to record the transaction is the data source, right? And after that data source, the figures of that the titles of account are gonna used in the books of prime entries, right? Books of prime entries are also known as books of original entries. These are the 7-day books, right? And then by this step, the next step is gonna be the ledger accounts. Every title of account has their separate ledger account, like cash, right, bank, or sales. So there are many. Each and every account has their separate ledgers account. Now after all that ledger account process, the next process is gonna be trial balance, where we are going to know that all the debits are equals to all the credits. Then finally we have a step which is the financial statement. All that transaction, if they are correct, they are gonna be entered into the financial statement. Books of prime entry. Now let's start reading the para. The ledger accounts of a business are the main source of information used to prepare the financial statements. However, if a business were to update their ledgers each time a transaction occurred, the ledger accounts would quickly become cluttered and errors might be made. This would also a very time consuming process. So the ledger accounts are the main source of a business information, right? Are the main source of any business financial statements, right? So whenever the transaction occurs and the accountant has to update their ledgers, so the ledger account would quickly becomes cluttered and error might be made, right? And this would also be a very time consuming. So that's why the accounting system every accountant should follow. For example, if already we have prepared the ledger account, right? So for example, yesterday we already prepared the ledger account, we are done with it. But today, on this date, before the financial statement year end, some transaction occurs, so we have to record it, of course, because the year is not ended yet. So the ledger account become so much cluttered, because after that transaction we also have to check the balances, right? And so that's why accounting systems are made to control such errors. Now let's have an example here. As you can see, that Ford Motor Company, according to their 2011 annual report, Ford sold 5,695 million vehicles in 2011. 2,686 million in the US alone, right? Ford would need to record 15,603 transactions per day for a full 365 days per year if it was to record every single sale in their accounting ledgers. That does not even take into account their associated purchases and payroll transactions. That is considerable volume of transactions to record in one set of account. So to avoid this complication, all transactions are initially recorded in a book of prime entry, right? This is a simple note of the transaction, the relevant customer or supplier, and the amount of transaction. It is in essence a long list of daily transactions. So by this example, we understand that from the beginning, every business should record their transaction. Whether they are salaries, whether they are any expense, whatever it is, it should be maintained from the beginning, right? That is something what it says. Now next is several books of prime entry exist, each recording a different type of transactions. Now let's understand this. Sales day book. Sales day book, you can check this. You can check the video of basic accounting concept, which is available on my channel. There is a deep understanding of this, the basic concepts of accounting, and there you can also check these as well. Now let's understand from this as well. So sales day book. Sales day book are the credit sales, right? Now to understand it, I have written here something for you. There are two types of credit, right? There is an account receivable and there is an account payables. Account receivable is a part of sales, right? And accounts payable are related to the purchases. And in sales, there are two types: cash sales and credit sales. As well as in purchases, there are cash purchases and credit purchases. Got it? The credit sales. Now let's understand credit sales. Credit sales are known as the account receivables, right? A business that has to receive past payment from the customer. And on the other hand, credit purchases are called as account payables. A business has to pay back to the supplier. Correct? It is something that you have to understand this, because I have write it down in an easy wording that you can easily pick and understand this topic, which is related to account receivables, accounts payable, credit sales and cash sales, and credit purchases and cash purchases. Now let's come back to the topic. Yes, sales day book, right? Sales day book are those books in which we have to record all the credit sales, right? And all the credit purchases are gonna be recorded into the purchases day book. Now let's understand sales written day book. Now let's come back to the credit topic to understand sales written day book and purchase written day book. Sales written day book. So maybe that customer received with some damages. So of course he will return us. Those returns are recorded into sales written day book with that customer name, right? ABC customer. That customer's name gonna be mentioned in that sales written book. Same goes for the purchase return daybook, so for example, I'm the customer, I received goods, but maybe the color I received is not that one that I ordered, right? So what I will do, of course I will return it, right? So that purchase return is gonna be recorded in my books of purchases as the purchase return, and the name I will mention in that book, in that purchase return day book, is that supplier's name. For example, XYZ is the supplier, so I will mention that XYZ supplier and my and the amount as well as whatever the details of that goods, right? Let's go back and continue. So we already understand sales return day book and purchase return day book. Now what is a cash book? Cash book is there are two types of cash: cash in hand, right, and cash which is in your bank account. That business bank account is your cash, and that both of those cash are gonna be recorded in this book, right? What are the petty cash book? They are the small cash transactions which are gonna be recorded into this petty cash book. There's a petty cashier in every business who record all those small transactions like stationery, miscellaneous expenses, that are the expenses which are not recorded in all these books, are gonna be recorded into this book, petty cash book. Now the journal, all transaction not recorded elsewhere. This is the book, the journal, in which all the transactions are recorded here which are not recorded in all of these 6. So the sum total of the day's transaction is recorded in the accounting ledgers of the entity. Entity means company or business. This is done in a double entry format. This important concept will be explored in greater depth later in this chapter. Yes, what I said before, we will understand this concept of book of time entry will be we are going to understand it later, but in this video I am also going to cover the double entry, and then we are going to end this video, the part 2 of this chapter. So now let's understand the double entry format, right? So whenever the transaction occurs, for example, a transaction in a business occurs like ABC company purchased furniture on cash $150, which is worth $150, right? So in the double entry bookkeeping. So to understand double entry, you need to understand that transaction, that what is happening in this transaction. And in this transaction, you need to understand this. And that is, in that transaction, you need to view capturing. You need to put the title of account. And after that, rules of debit and credit. So whenever the transaction occurs, there is a concept of duality. And what is duality? That each transaction has two aspects. For example, in this transaction, you can see ABC company purchased furniture on cash, $150. So by this transaction, we can easily find that we have purchased. The purchases is our expense, right? Purchases are the expenses, and we have purchased it on cash. So this is our asset. So by having that furniture, right, of course furniture is my asset, but I got it by paying some amount. So I did an expense for my business, and so that furniture is my expense, and it will be recorded as purchases in the format of journal as like this. It's a simple format of journal. In ACCA, you are not going to be asked to make the whole format. It is simply like you can understand it, what are the formats of each and everything. So these are the debits and these are the credits. Now in this transaction, as you can see, ABC company purchased furniture on cash, $150. So one thing we know, that we are getting our furniture. That is purchases, and it is an expense. So whenever the expense increase, it has to be shown on the debit side, which is $150. And in the same transaction, we can see that something is going out, right, and that is cash. Something is going out from our business, and that is cash, and that is an asset. So whenever the asset decreases, it can be shown into the credit side. So we can see that our debits are equals to the credits, and that is all about the duality concept. I hope you understand all the concepts that we have learned today, and drop a comment if you have any questions, and like this video, share this video with your friends. Till the next video, take care.